The headline here, the Fed holding rates steady, but kind of indicating 3 cuts still coming at some point this year. Andrew, let's just start your reaction to the headlines and the news here.
Well, I think that the dot plot is problematic because it only shows a baseline outlook. And that baseline outlook hasn't changed at all. It's almost identical to the projections that the Fed released 3 months ago. The problem is that there's an alternative scenario in which inflation doesn't settle down close to their target the way they've been hoping. Unfortunately, the dot plot just doesn't convey information about the risk. Personally, I've been on this program in December. I said there was a serious possibility that the Fed might not be able to cut rates this year. I still see that as a very significant risk. You look at what's happening to service prices. Service price inflation has actually been picking up speed. It's not slowing down, not decelerating. So again, what's unfortunate here is that the Fed's statement says they're attentive to the inflation risks, but their communications isn't really flagging that very effectively.
Yeah, Andrew, on that point, do you think that Jay Powell will acknowledge that possibility in the press conference today that maybe there are no cuts coming? And can he, without sort of causing chaos in the markets?
Well, I think one thing that will probably come up today is kind of pushing back a little bit on the timing of the cuts. The markets are currently expecting that the cuts are going to start in June. What seems more plausible to me is that many Fed officials are thinking of something more like summer, early fall. So they could still cut 3 times, but that would be September, November, December. That would give them some more space to wait through, spring at least into summer to kind of really make sure that inflation's settling down the way that they're hoping. And if it doesn't, then they could wait even longer to pull the trigger to start cutting rates.
And George, let's bring you in here as well and get your response to this news. Is it about what you expected, George?
I think it is largely what I expected. I think it's what the market wanted, probably more importantly. And the market seems to be taking this as good news. To Andrew's point, though, I think the Fed probably missed an opportunity to try and recalibrate policy slightly. I think the market might have been giving them an out if they decided to maybe take a cut away this year. They've kept 3 cuts in place, though. And I think with good reason, they suggest that maybe they don't have confidence yet to suggest that things are fully back to normal. So we too think that inflation is still going to be somewhat problematic, particularly on the services side. We made a lot of progress. So a year ago this time, inflation was running close to 5%. Today it's in the high 3s, which is still progress. And markets probably anticipated that. But at the same time, we haven't returned to what normal policy rates should be and what the Fed wants them to be. So I think the Fed missed an opportunity to try and slightly readjust policy. You're right to point out, Julie, that the fact that the initial reaction is not the final reaction, but thus far it seems like the markets are taking this as good news and rejoice in that. But I think at some point later this year, we still have to come back to some realization that inflation is not yet cured and needs to be addressed.
And Andrew, to come back to you, are you a believer in the so-called idea that the last mile is the hardest here? Is it, we're starting to see gasoline prices creep back up? What's going on here? Why is it so hard?
Well, I think that an important point here is that we're not on the last mile. And just to underscore this, 6 months and a year ago, Chair Powell was emphasizing what he called supercore, which was the service sector excluding housing and utilities. Supercore inflation was looking really good during the first half of last year. It was coming down really fast, getting close to what even looked like could be a 2 or 3% reading, which was very reassuring. The problem now in the last few months is that measure's been going back up. The latest 3-month series supercore is now at 6%. And the 12-month rate is at 4.5%. So this isn't just gasoline prices. The supercore are the really inertial parts of the economy, the most inertial, stickiest prices. And so if those are running well above the Fed's target, then it could turn out to be very premature for the Fed to start tightening this year. That's, again, it's a risk case. It's not necessarily the base case.
And George, as the markets guy in the panel, let me bring you back in here. I'm just curious, George, your take on, does the Fed have to cut for the market to move higher this year, George, or no, investors, it's not all about the Fed anymore. They're more focused on the economy and corporate profits.
Well, Josh, I think the market is largely focused on AI right now, right? I think the Fed is kind of stepped away now to take away at near-term risk. I thought, frankly, coming into today's report, we might see some volatility, perhaps even a sell-off, if in fact the Fed adjusted policy as I suggested they might have. The fact that they didn't do that, however, suggests maybe some market participants that it's all clear. But I agree with you. I think that we still have not really made sufficient progress, frankly, on the inflation side for the market to really feel completely comfortable. I think the Fed also would have to acknowledge at some point that there is this thing called the wealth effect that's happening, and that likely could lead to further spending. We've seen maybe some softness in spending in the first 2 months of this year. Some of that, I think, is a give back from what we saw at the end of last year, where spending was very robust. But thus far, spending this year has been a little bit tempered, and we've seen consumers reach into their credit cards and other forms of payment to try and really bridge the gap between their depleted savings. But I would suspect that because of the wealth effect, maybe the spending boom that we saw last year might repeat itself in the second half of this year. And to Andrew's point, we might have to address inflation and some of the pressures from inflation in the second half of this year still.
So, George, does that suggest then that if investors are sort of ignoring the Fed or not paying as much attention to the Fed because they're looking at the AI shiny object, that they do so at their peril, that there is a risk there?
Well, I think you have to be careful because I do think that AI is real, and I think there is some long-term staying power behind the AI trend. But yeah, I think at the same time, when you see market multiples approaching 22, 23 times earnings, that gets to be a little bit elevated. And the risk of the fact that there isn't as much risk in the market anymore, I think that also begs the question that we're probably due for a pullback at some point. So I think in the short term, yes, I think that investors should be prepared for some volatility. Long term, however, though, we still think that AI is real, and I think it has a lot of legs on the long-term basis to really inflect the economy in a positive way.
Andrew, I want to get your take on another issue. You'll hear some economists and some well-known economists, Andrew, and they'll say, when it comes to the Fed's inflation target, they should be more open to this idea of moving the goalposts, Andrew, that, they should learn to kind of live and love 3%. What's your reaction to that?
Well, the Fed actually has a mandate from Congress. It's now more than 50 years old. Maximum employment and price stability. And when Congress gave that mandate, people thought price stability meant something close to zero inflation. In the 90s, Chairman Greenspan said, well, 1% might be okay. In the 2000s and over the last decade, the Fed said, well, 2% is actually a good number. Many other central banks target 2%. That allows a little bit of a buffer. I think that if the Fed were to change the target upward further, it would be a more clear deviation from what the law says. And I think they would have to have congressional hearings to discuss either Congress changes the mandate and gives them more latitude to target whatever they want, or the Fed has to get inflation back down on a sustained basis to what's at least reasonably consistent with price stability.
Interesting. And so, George, as we all try to figure out what the Fed is going to do here, are you making any changes to your strategy here? Are there things that you're going to be listening to specifically from Jay Powell to sort of key off of when it comes to what you're doing with your portfolios?
I don't think in the near term we might be loath to make any changes. I still think we want to be balanced towards risk overall. There are certainly elements of the market that are still attractively priced, whereas some of the so-called Magnificent Seven stocks or maybe the Fabulous Four are a bit overpriced in our view. But we still think the market is reasonably valued to some extent. And I think the fact we have to recognize is that the Fed is still trying to find their confidence and trying to find where equilibrium should be with respect to the policy rate. So there is a fair amount of uncertainty, and for that reason, we're not likely to take risk up, but we're not also likely to take risk down because there are still some signs of hope and some signs of optimism in the economy still. The fact of the matter is that they adjusted their growth target up, I think also needs to be mentioned, irrespective of their outlook for inflation, which as you acknowledged was a tad hotter, but they also adjusted their forecast and their outlook for growth, which essentially is marking to market what we already know. But I think it is validation that there is still some economic strength underlying this economy, which is still quite healthy.
Andrew, we're going to hear from Jay Powell very shortly here. If you were at that presser, Andrew, what's the one question you would have for Mr. Powell?
Well, again, it would help. By the way, I was one of the people who worked with Ben Bernanke and Janet Yellen when we designed the dot plot a decade ago. But there's always room for improvement. And I think another limitation of the dot plot is it just shows kind of the end of the year without giving any sense of timing. It would be constructive today if Chair Powell would clarify the likelihood that the first cut's probably not coming till late summer, early fall. That would help the markets, I think, at this point. I think part of the market risk that I see is that every FOMC meeting over the next few months, the Fed keeps pushing back the market expectations incrementally to a later meeting. And that would probably create some downward pressure given all the other strengths that George has mentioned.
Yeah, well, we'll see if part of that happens today. Andrew, George, thank you so much, guys. Really great to catch up with you.
Thank you.